Welcome to this explainer. Today, we're going to take a very calm, deeply analytical look at a problem that completely destroys even the most promising trading careers. We're going to deconstruct exactly why serious, dedicated traders consistently blow funded accounts. And more importantly, we're going to look at how to fix it by shifting your mindset away from being reactive and toward a structured, timing-based execution framework.
I want to anchor our entire discussion today with one single powerful mantra. Doing nothing is a high-skill activity. Think about that for a second. The typical retail trading mindset is hyperactive, right? It's chasing candles, it's forcing trades just out of sheer boredom or a need for action. But true institutional execution relies on mature, patient discipline. Quite often, the absolute most profitable decision you can make in the market is to simply sit on your hands. Section 1, the anatomy of overtrading. Because to understand how to wait, we first really need to understand why we feel that uncontrollable urge to just click buttons.
You probably know this cycle all too well. These are the classic symptoms of what we call emotional contamination. Look, when you take a loss, or maybe you start feeling that payout pressure, an emotional urgency sets in. And that fear of losing inevitably mutates into frustration, which then spirals into revenge trading. Eventually, your confidence just collapses, and totally impulsive, fear-based execution takes over the wheel. Now, the key here is to treat this not as some sort of moral failing, but as a mechanical breakdown of your system. When you're operating from an emotional state, you're literally forcing setups that are completely outside of your edge.
Section 2, survival before profit. Escaping this destructive loop really requires a profound shift in how you view your role in the market.
Notice the incredibly stark divide between retail and institutional thinking here. The retail hierarchy is entirely focused on profit, which feeds the ego, which is built on hopes and dreams. But the institutional hierarchy, it's completely flipped. Survival is paramount. Survival leads to strict risk control. That risk control protects the process, and it is the process that ultimately yields profit. Survival, risk control, process, profit. That is the order of operations.
Moving on to Section 3. The architecture of timing. A huge part of surviving is finally accepting that the market is not random. It operates on strict, scheduled timing windows.
You see, price delivery is largely governed by a rigid 60-minute cycle, which is heavily utilized during the London and New York liquidity windows. Let's break this down. From minute 0 to 12 of the hour, we have accumulation. The direction is intentionally kept unclear. So your action, no trade. Then, from minute 12 to 20, we see the manipulation phase. This is where the stop runs happen. Finally, from minute 20 to 30 and beyond, the distribution phase kicks in, and that opens up your actual valid entry window.
Now that schedule pairs flawlessly with the AMD cycle: accumulation, manipulation, and distribution. The market essentially accumulates orders, manipulates price to sweep the liquidity, and only then distributes into true continuation structures. Now here's the catch. That manipulation phase, that is where the highest revenge trading risk occurs. You get stopped out on a false breakout, you get incredibly frustrated, and you re-enter emotionally, right before the true distribution actually happens.
Section 4, liquidity and order pairing. Let's look a bit closer at how institutions actually use this timing framework to engineer liquidity.
A really absolutely crucial concept here is the failure swing. These are failed highs or lows, where retail traders have conveniently clustered their stop losses. And this trapped liquidity creates a very low resistance target. The algorithm efficiently revisits these areas to rebalance price action and pair those institutional orders. So instead of reacting to every single green or red candle you see, professionals wait for these specific liquidity sweeps to reveal the market's true intent.
I really want this concept to fully sink in. Liquidity is the fuel. Price is simply the output. Chasing price action is the ultimate retail trap. Professionals, they don't chase the output. They patiently wait for liquidity sweeps and order pairing to happen within those scheduled time windows we just talked about.
Section 5, the mechanical trading plan. Because, frankly, to protect ourselves from ourselves, we need rigid structural rules to prevent an emotional override.
The number 7. What does that mean? Well, this represents the 7 out of 10 emotional neutrality score. Before you take any trade, you have to assess your own emotional state. Are you calm? Are you actually focused? If your emotional stability drops below a 7, the trade is automatically invalid. Actually, scratch that. The entire session is terminated immediately. Zero exceptions. Your discretionary analysis quality drops off a cliff when you're emotional. and this strict rule is what protects your capital from your own sense of urgency.
And hey, if you do take a loss, you must enforce the 20-minute cooling period. This is a non-negotiable survival mechanism. Taking a loss, especially a manipulation stop-out between that dangerous 12 and 20-minute mark, triggers a severe risk of revenge trading. So for 20 minutes, you step away. No looking at charts, no agonizing over what went wrong, and absolutely no re-entry. This forces emotional regulation so you can return to a state of absolute neutrality.
Which brings us to our final part, Section 6, Precision through Patience. By enforcing these rules, we step away from being reactive gamblers.
Every serious trader should recite these tenets calmly before a session even begins. This is your identity declaration. I am not a reactive trader. I wait for alignment. I do not chase expansion. I do not negotiate with emotional urgency. I operate with structure. Reading this acts as a sort of psychological performance coach. It shifts you from a civilian, emotionally driven mindset into a grounded institutional framework. Always remember, patience creates precision.
And ultimately, it all builds to this realization. Consistency is behavioral repeatability under uncertainty. It is about consistency of self, not perfection of prediction. It's about executing the exact same mechanical process and waiting for the exact same windows, completely regardless of the outcome of any single trade. As we wrap up this explainer, I want to leave you with a question to reflect on regarding your own psychological maturity and execution discipline. The next time you sit down in front of the charts, ask yourself, are you executing a precise, time-based process designed for survival, or are you just reacting to the noise? Remember, doing nothing is a high-skill activity, and at the end of the day, only timing survives the noise.